Enphase released their Q3 earnings last week, and to call it a surprise is a bit of an understatement. What we'll do in this video is we'll go over what was released, what was guided for, and ultimately what kind of impact it might have on the share price in the short to long term. So to kick things off, what we're going to do is I'll give a brief overview of some of the changes that were made. We'll go over the structural updates that were made to the valuation model, and from there we can get more into the numeric stuff, like what was reported for the Q3 earnings, as well as what was guided for Q4 and beyond. So to simplify things, we'll zoom out quick. The biggest change that was made to this model is previously this went out 3 years. It's now going out 5 years. So this brings us to the end of 2029 or the start of 2030. The next section that got an overhaul was the key performance indicator section. You can see it's color coded. So yellow is for the microinverters, blue is for battery, purple is for EV chargers, and white is miscellaneous. So the way that this is organized is up top, it's like the capacity, the production, and then what is actually shipped. So it's kind of like what their potential is, and then trickles down into what's actually being executed. The last section that was added is a section for charts, and then finally a footnotes/history section. The reason that I added the history section is so that the user is familiar with if they're using the most updated version of the model. If you're interested in downloading the model for yourself, feel free to. The link for this one, as well as Planet Labs and Rocket Lab, are available in the description below. All right, so let's get into the numeric changes. I figured the easiest way to go about this is just to simply extract all of the guidance that was available, whether it be through the fourth quarter financial outlook, as well as some stuff that was said in the call, as well as some stuff that was mentioned in the 10Q. So I've formatted this in a way that kind of just goes point by point and will more or less go top down and kind of look at the implications that it has for the bottom line. So what we're going to look at first is the updated guidance for the IRA credit. Previously, this was expected to be somewhere in the mid-20s range, but we pretty much have a spot-on figure for what to expect going forward. So in the financial highlights for the third quarter, the GAAP gross margin was 47.5%, inclusive of net IRA benefit of 2.6%. As a percent of revenue. So if you take that 2.6% and you multiply it by the revenue, which is $551 million, you're going to land at $14.3 million. From there, you can take that $14.3 million and divide it by the number of units that were produced from the US facilities, which was 531,000, and you'll land at $26.98 per unit. To make things simple, we'll just round that up to 27. It's 2 cents off. Now for the Q4 guidance for the IRA credits. There's 2 quotes that can be extracted from this earnings. The first, we expect the production credit net of any incremental cost for domestic manufacturing to be in the range of $26 to $28 per microinverters sold to customers in Q4. And the second quote, net IRA benefit to be within a range of $26 to $28 million based on estimated shipments of 1 million units of US manufactured microinverters. So the simple math here is we're just going to land at the middle number between 26 and 28, being 27 million, and divide that by the 1 million units, which is $27 again. So because of that, this number on the far side, right here, the IRA production credit has now been increased from 25 to 27. So if you're unfamiliar with this model, any of the dark gray cells in the multiplier column, these can all be updated. So if you think that I'm too low on something, it can easily be adjusted upwards. And if you think I'm too high on something, it can be adjusted downwards. And there's a whole bunch of different variables that relate to pretty much everything. The IRA credit, the production capacity, the operating expenses, earnings, free cash flow, you name it. It's a very malleable model, so feel free to play around with it. So next up, we'll get into the ugly part of the earnings, which was the forward guidance. I'm definitely not alone when I say that Q4 guidance was a bit of a surprise / rug pull. Previously, I was expecting Q4 guidance to be in the range of 600 million. And that's not just me, that's all of Wall Street was also predicting, I think it was in that same range. I think it was just north of 600 million. So when Enphase came in and they guided Q4 to be 300 to 350 million. I mean, it was surprising. I don't know how else to say it. It was surprising. And I think that the reason that it felt like a bit of a rug pull is, this is from the Q2 call in reference to the upcoming third quarter guidance. They mentioned, we are assuming the same level of uncertainty continues going forward. Therefore, we are taking aggressive and prudent actions in the US to manage down the channel inventory and this is reflected in our light third quarter guidance. Throughout the rest of that call, I got the impression, maybe this is my bad, but I got the impression that this was kind of a one-time correction. And I think that a lot of other people that I've spoken to about this also had the same impression, that it was just kind of like, okay, they're kind of correcting their inventory levels, and then Q4 going forward, back to business. But then we got this Q4 guidance, and they did kind of explain it. And if it wasn't for my kind of misunderstanding from last quarter, maybe it wouldn't feel like such a rug pull. But either way, we can talk about why this quarter as well as the next couple maybe isn't so bad. Or, I mean, we'll just add a little context here and kind of give Enphase the benefit of the doubt. So what I've done is I've taken a few quotes regarding Q4 and onwards, and I've kind of structured them in a way that is somewhat linear. And then after that, we can kind of look at the implications that it'll have on the next few quarters. So referring to Q4 guidance, during the call, they mentioned that they are guiding for the $300 to $350 million. And they followed up saying, this reflects approximately $150 million of channel inventory correction in the US and Europe. In other words, we are under shipping to the end market demand for our products by approximately $150 million. We anticipate under shipment will continue in Q1 and expect our channel inventory to normalize in Q2. Later in the call, during the QA section, for obvious reasons, they were kind of pressed a little bit on forward guidance. So what we'll do here is I'll just kind of talk through them, but I'll put the quotes on the screen so you can read them with a little more context if need be. So of that $150 million undershipping correction, they mentioned that it is approximately equal between US and Europe. They also mentioned that they're expecting Q1 to be a little less than the $150 million, but not too much less. So what we're going to do with that is we're going to use that quote and anticipate Q1 to have a $125 million correction. The last quote that we have from QA, it kind of highlights what to expect in Q2 of next year. For Q2 onwards, we think the channel inventory is going to approach normalized levels. And therefore, that normalized level, assuming the demand picture is unchanged, that normal is what we said, roughly around $450 million to $500 million is that normal level. This assumes no change in demand from the current situation. So that essentially gives us guidance out to Q2 of 2024, which is, I put it in the mid-range of that $450 to $500 million, being $475 million. This paints a very different picture of what was originally expected. So the $600 million that was expected in Q4, we're not going to see that till maybe Q4 of next year at this rate. Because if normalized levels is 450 to 500 million, and that's what's expected in Q2, that's not looking very good. So if we take that and then we look at the cost of revenue, which again, all of this stuff is formulaic. So this number can be changed down below via the gray cells. If we just simply take all of this and run it through what is a giant calculator or model, formula set, we can ultimately look at what the gross profits are going to be going forward, what the operating expenses going forward, and everything down to, virtually anything within the income statement. So with all this guidance and with all of this anticipation of what the net income and whatnot could look like, that will feed into everything else down into the calculator section below. We'll also update, most importantly, the earnings and free cash flow expectations. These are for 16 quarters. And the reason for that I didn't go back a little bit further, if you see next quarter, I'm expecting that EPS is going to be down to 0.09, just based on what we're seeing here. And that's going to be comparing it to 1.05. So it's going to look like earnings absolutely collapses. But then on the flip side of that is once they're through this little hiccup period, because like I've mentioned previously, solar's not going anywhere, and Enphase is 30 to 40% of the overall market. So when solar kind of makes a comeback, it's more than safe to assume that Enphase is going to be riding that wave. So when that happens, going down from 0.09, for example, the next one's going to be 68. That's going to be a huge percentage increase But it's only because of 0.09's proximity to 0, if that makes sense. So it looks like it's 6x, 7x. It's not the most fair way to look at it. And as a result, I'll scroll down and show you what I mean. It's going to look like the earnings growth is up by 685%. So as a result, I'm naturally going to exclude that outlier and any that are similar in that range. I think this is the last outlier that we have is the 126%, because again, comparing Q1 2025, which should be better than Q1 of 2024, it's not a very fair comparison. So we just kind of exclude any of those anomalies that are going to, yank the average growth higher than is fair to assume. Hopefully that all made sense, but we're just excluding the outliers so that we have a smoother trajectory on what to expect going forward. And ultimately we land at 22%, which I think is a fair assumption to make for solar growth as an industry going forward. And assuming that Enphase keeps their market share, or even if they lose their market share a little bit, they're still going to grow at definitely 15, 20, maybe 25% for the foreseeable future going forward. Obviously, that's not set in stone. That's just my assumption on where the world is going. So we take all those numbers, all those growth rates, and we kind of feed them into the calculator. We're ultimately going to arrive at what we're ultimately after is the share price. In this case, under all of these assumptions, it looks like 200 to start 2030. That seems fair. Now, if you were to rewind that back, you'll see that the share price has gone way down, as a result of what was just reported. Now, this number looks insane as far as a fair value. This is current value, by the way, for the share price. I do not expect the share price to go down to 32. I also wouldn't rule it out, but I'm sure it won't get there because the market always looks forward. And in case it's not obvious, this isn't a crash and burn situation. During difficult markets, it becomes survival of the fittest. And there are companies like Enphase that have a lot of cash, they're $1.8 billion, and they seem like they're able to weather the storm. Enphase could have quite a few quarters of this rough period, and they would still come out the other side feeling good, still having their top tier technology, and still having enough cash to keep themselves alive. The same cannot be said for some of the competitors. So if you just look at the market, as a percentage, somebody needs to consume the market share that was otherwise being taken by the companies that will no longer be there in a year or two if things get bad. And when I look at Enphase and when I look at the companies that are going to go extinct, it seems obvious who is going to fill that gap. So all that being said, Enphase is going through a really rough time. The entire solar industry is going through a really rough time. And I hope that I'm not being blatantly or blindly optimistic, but I'm still just not worried about it. Like I said previously, the market is going to buy quarters, if not years ahead. And if you're looking at what fair value is, sure, we might stagnate around the $80 mark or lower for, till the end of 2025, but maybe not. And you're kind of left with that conundrum of do I add here? Do I wait? One last quote that I'll leave you with is from management regarding the share price. Referring to buybacks, they mentioned, I think this is an opportunistic time for us where we can take advantage of the stock price. So we will be opportunistic about it. Now we'll pair that with how much they have available for the share buybacks. So since July 2023, since the share buyback of $1 billion was approved, in the third quarter, Enphase purchased approximately $110 million worth of Enphase stock. So 1 billion minus 110 million, that's $890 million left for Enphase to be buying the dip. And then if you look at how much cash they actually have available to buy that dip, you'll see that it is in the range of $1.8 billion. So if you're combining these two, that comes up to just shy of 1.8. So that's cash equivalents and marketable securities combined. And of that 1.8 billion, they have that, we'll call it $0.9 billion to sustain the share price. That's essentially what they're going to do. So I wouldn't, I feel like I keep saying the same thing and keep being pushed back against, but I would not be surprised if Enphase continues to bleed, especially after how horrendous, absolutely horrendous, the Q4 guidance was. I mean, maybe I'm not being bullish enough. Maybe they're going to do a lot better, maybe a lot worse. I don't know. Again, if you're interested in manipulating these numbers for yourself and telling me that I'm directionally accurate or completely wrong, links are in the description below. Aside from that, I'd love to hear from you guys. Excluding the Enphase model, the Rocket Lab model, the Planet Labs model, what would you like to see me cover? What other kind of companies are out there that you think have a optimistic runway or that you're just more curious about? I'm open to suggestions, so let me know in the comments below. Thank you guys for hanging out, and I'll see you in the next one. Cheers.